Hello, everyone. So, welcome back. This is the continue of Chapter 10 lecture. So, we are going to continue with our previous discussions on the investment and saving identity. And we are going to put that identity into a model so that we can actually understand a little bit more about the determinants of how fundings are being allocated in the economy for investments. So last time we kind of used our very simple derivations of the models to identify the total national saving will become the total investment spending in a very simple basic economic setup. So today what we're going to do is to think about can we build a model, right? So can we actually build something that we can use to explain the total amounts of saving and investments determined by the economy? So the model that we are going to discuss today is called the market for loanable funds. So whenever you actually hear about the term markets, yes, so we are going back to our fundamental market analysis here. So we are going to build a market using the supply-demand logics to find out how the investors and borrowers or lenders they are trying to come together and determine together equilibriums, quantity of fundings in this financial markets. So in this market for loanable fund, just very briefly to give you an idea, we have the demand side of the market and the supply side of the market. This loanable fund market, it's basically used to generally discuss the total amount of loanable fund. And when we talk about loanable fund, it's basically the total amounts of funding that goes into the firms and businesses to invest for future production, right? Because firms and businesses are the one who usually will need to borrow the fundings to invest for their future projects. So in this loanable fund market, we actually have the supply side of the funding, who are the one who supply the funding to the people who needs the money. Obviously is the households. So the household is the one that actually doing majority of the saving in the economy. So they are the one who determines how much of their savings should be going into the economy. So one very quick notes here for people first time seeing this model. As you can see, we don't have the price for the loanable fund in this model, but instead we actually using a different units here to define the cost for saving, actually the benefits of saving and also the cost for borrowing. So interest rate is what we're going to use as the price tags of this funding. And on the other hand, we have the firms, which is the demand side of the loanable fund markets, where they are going to borrow the funding. They are going to borrow it from the households, and they are going to spend it on the investments for expansions of the future productions. So in this market for loanable funds, both sides of the markets, the borrowers, which is the firms, and the lender, which is the households, they will ultimately find this one very efficient equilibrium points in the market, so that there will be an specific interest rate to be found and a specific quantity of fundings to be found in this market models. First of all, let's talk about the factors that shift the loanable funding markets. And we would like to think about the demand side of the market, which is the firms and businesses. So we want to know at a given interest rates, what would be the factor that shifts the behaviors of the firms to either borrowing more funding or borrowing less funding? So number one, because well, firms only care about the profits. So whenever there is an opportunity for the firm to earn additional profits from borrowing the funding from the households, most likely the firm will make a rational choice to borrow it out and try to invest. So for a very simple example, let's say if Apple, they found out that there is a new product that they would like to invest to sell it in the market, but the development of this product will take about $1 million. The returns of this new product in the market, it's perceived it, or maybe it's projected to be 5%. So to invest $1 million, Apple is going to get 5% returns from that $1 million. So seems like a very good deal for Apple to invest the money. Again, well, if Apple do not have that cash flow, right, that liquidity in the economy to spend on this $1 million, what most likely happen is Apple will have to find someone who has that additional amount of money, right? So those assets, financial assets, to borrow it from them and try to invest on this project. So the idea is if Apple find one household in the economy, let's say this household is willing to lend the money to Apple at a cost, let's say they're charging an interest rate of 2%. So if 2% is the cost for Apple to pay for this project to get the $1 million, and the return from this project is projected to be 5%, very likely Apple is going to take out the funding and try to invest to the market. So whenever the perceived benefits for business opportunity or the perceived benefits for investing the projects relative to the cost, every time the perceived opportunity increase, it will attract more firms to invest in the economy, to make them more motivated to take out the funding from the loanable fund markets. Well, another shifters that most likely will happen, and we are going to discuss more later, is when the government actually stepping into this loanable fund market and trying to borrow more funding. And in this case, when the government is running a budget deficit and they need to demand this loanable funds from the private market, this will definitely increase the demand for loanable funds. And in this case, we're given a very specific name here. We call this a crowding out effect. Well, on the other side, the supplies also have some determinants of the shift of the supply curve. So the supply curve will shift in this loanable fund markets because number one, maybe when there is a private saving behavior change, maybe when the household seeing the income falling significantly in a particular period and they want to actually save more, maybe for the future periods, or maybe sometime when they actually seeing the significant fall of the income, they may even force themselves to save less. So it really depends on the situation, or maybe unexpected or expected unemployment. When people seeing the friends are getting laid off and somehow they are worried about their future, they're getting paid the same right now, but they worry that in a couple of months they might actually lose their job. So they will start saving more. And sometimes people save the money into the assets, maybe because they have this tax incentive that change the behaviors. So for instance, people who put the money into the 401k accounts, right, which is also part of the saving for the future. So government actually provide tax incentive for them to not pay tax, right, on those long-term retirement fundings. So there are several examples that you can actually think of with the tax incentive. So either one way or the other, when people are getting more motivated to save more money, this will shift the supply curve to the right. If there is a decrease in the motivation to save money in the economy, then it will most likely shift the supply curve of loanable fund to the left. Well, we didn't talk much about the open economy, but when there is a change of the net capital inflows in an open economy, that will also shifting the supply curve. So think of the net capital inflow as kind of like a additional saving from the international world. So maybe someone in the world, they would like to invest the money into the United States, and they put the money into the United States, and for our private firms or maybe governments to borrow. So one thing that it's very, very interesting to see in this model is we are not only trying to investigate on what is the equilibrium interest rates from the loanable fund markets, and obviously you can see it from the graph, but another very important thing that you should note is how this model helps us to understand the policy. As you can see in the previous slides, we talk about the demand shifters. One of the main demand shifter would be the government deficits. The budget deficit will increase the government's demand on loanable funds because the fact is government, when they face a deficit, they have to somehow find some way to cover their bills. And loanable fund market, it's where all the money where people are not going to spend yet. So obviously, government will definitely will go into this market and trying to borrow the funds from the households. However, when the economy actually having budget deficits, when the government running the budgets, it will increase the demand significantly in the loanable fund markets. With this increase in demand, obviously, we are driving the loanable fund market's equilibriums to a different point. And specifically, I would like you guys to pay attention to the interest rate change in this loanable fund market. So when the government step into this market and trying to borrow more funding, the demand is going to drive up. So we are going to see the demand shifting to the right. And at the same time, the equilibrium interest rates for loanable fund will increase. It seems like, well, you might actually suggest that, hey, the total quantity of funding actually increase. So the investment in the economy must be increasing. But you have to keep in mind, this total amounts of loanable funds are not going into the firms and business hand completely. And if you look a little bit more carefully in this graph, when the interest rate goes up, if you look back to the original demand curve, you will find how much of the funding will be borrowed by the firms at the interest rate of 8%. So when you look at this graph, when the interest rate go up to 8%, when there is no government involved in this market, if we look at the original demand curve, the total amount of funding by the firm, it's only 20 units, or maybe $20 trillion or $20 billion. So $20, let's say. So there is a gap between the equilibrium to the 20, right? So the new equilibrium is 40 units, but the original demand curve suggests at 8%, firms only take out 20 units or $20 of funding. So the gap between the two basically explains to you how much the governments are taking out from this equilibrium conditions. So the $20, let's say, from $20 to $40, right? The $20 gaps, it's basically what the money will be taking from the governments. The government will borrow from the loanable fund markets. And comparing to the previous equilibrium, where the firms can actually take out $30, now the firm will only take out $20 at a higher interest rate, then obviously the firms are actually going to borrow less money to invest in the economy. And that's why the expansions of the economy might actually ultimately slow down by the actions of the governments. And this effect here, it's what we call the crowding out effect. It's basically mainly because of the budget deficits of the governments. Well, the loanable fund market help us to actually explain how the interest rate is being determined, how the total amounts of loanable fund will be determined in the economy. and also how the government deficit might play a role in the developments of the economy. Now, let's just spend a few minutes to just go over some of the very common terminology that we know about the financial markets. There are a total of four main types of financial assets that exist in the markets that help reducing the transaction costs of the people. So let's go over them one by one very quickly here. So one of the main types of financial assets, we call this the loans. So loans are basically the very general terms to cover like student loan, car loans, mortgage loans, small business loans. So all these loans are basically the assets that it's being defined in a financial system. Bonds, it's another very common type. Bonds are basically what we call the IOU certificate. So IOU basically means I own you something, right? So it's kind of like a borrowing certificate. So usually it's issued by the borrowers. So there are very common company bonds, government bonds. So these bonds are basically like a borrowing types from the big corporates or maybe sometimes the governments. However, you have to keep a note. The bonds has a risk of default. So whenever the bond issuers actually fail to make the payments back to the lender, a default will be filed, and sometimes people might not even get back their money. There are other types of assets like the loan-backed security. This happens during the Great Recessions, right before the Great Recessions, when people actually putting a lot of this mortgage assets into a repackaging as a loan-backed securities and sell it to individual peoples for profit returns. So those loan-backed security, it's basically like a new way to create a new assets in the economy for people to get the individual loans to accumulate into a pool. Stocks is another very, very common types of financial assets. So stock, it's basically the share in the ownership of a company. Most of the time, the value of the stock depends on the supply and demand in the stock markets. It fluctuates a lot, so that's why it usually returns. It usually has a very high risk involved, but also because of the high fluctuations of the prices, it also sometimes provides a very high returns. Well, the financial assets are the one that we actually deal with a lot. But then who are the one who actually making those decisions, right? So who are the one who actually help us to complete the process for getting those assets? So there are some key financial intermediaries that you might already know, but we're just going to go over there very quickly. So number one, mutual funds. So mutual funds are basically the one who diversify the portfolios of the stocks. So to basically make a combinations of the high risk, low risk stocks and put it into a one single funding so that people can invest the money, they can save the money into this mutual fund with a balance of diversified risks and a mix of returns rates from different stocks. Pension fund, it's another management funds, but usually it's for nonprofit institutions to collect the saving, to invest those money into different kind of assets like stock markets, global assets markets, resources markets, maybe different types of bonds in across the world. So it has a variety of assets that the pension fund actually put into. Ultimately, what we are trying to do with the pension fund is to provide the member with income when they actually retire. Life insurance company. It's another agency that very common brought up in the financial system. So the life insurance company usually will collect the premiums from the policyholder whenever the policyholder they reach the age, right, they dies, the life insurance will kicks in. But obviously, the insurance company, they're not going to just save the policy premiums in the bank. They will use those funding to actually invest in different types of assets in order to gain the values of those assets. So when the person dies, not only the person will get a huge leverage from the premium, but also at the same time, the company will be able to make some profits of the investments. The last one is the bank. The bank, it's basically the simplest that you can imagine. They handle the fundings day by day. So every single minute, they have people deposit the money to the bank, save it, and at any given time, they can actually approve a loan to maybe small businesses or maybe homeowners, buyers. So bank, it's basically the place where all the money it's being goes in from the saving side and also going out to the borrowers in the economy. Well, in the economics study, there are a lot of great events that we could study about this financial markets, especially there is one that happened in the year of 2000s. We call this a dot-com bubbles. So during this period, what interesting enough to see is we actually see the assets pricing for dot-com stocks actually went up dramatically during this 4 years period because of the people are well actually very optimistic about the growth of the dot-com companies. Right? So the technology that we have back in the days. The growth of this, the successful growth of this dot-com companies or stocks is driving the stock markets up to a very, very high level. But unfortunately, when the stock markets actually went up so high, the asset values of all the stocks are basically bought. So all the prices went up so fast, and the values of the stock does not reflect to the true returns of the company. And when the bubble actually bust in the year of 2000, what happened is those tech companies failed to actually prove their revenues, right? Prove the ability to make money in the economy. And many of them actually failed and shut down, the investor losing confidence into those tech company, and the stock markets for those dot-com company actually declined by almost 86% in total. Even eBay and Amazon, those strong dot-com company, actually see their stocks soar by so much. So this is another way to actually reflect on how important it is to maintain a stable and monitored financial markets, so that people are not overbuying or not going too crazy about those investments, right, in the economy. We do not want people to losing their assets in general to those unstable financial market. We want people to at least have a very stable and risk-free returns, or not risk-free return, but low-risk returns from the assets, so that they can actually save their money into a relatively safe place, so they can actually make a living for the future. Well, since we are on the topic of interest rates, so the last thing that I would like to go over is whenever we talk about interest rates in this loanable fund market model, we always relate it to the real interest rate return. So the real interest rate that we studied in the previous chapter, we look at the equations, which is the nominal interest rate minus the inflation rates by definitions. However, the problem is most of the time when we're trying to calculate the real interest rates at the moment, when we're trying to figure out whether we should save our money or borrow some money from someone. The inflation rate usually is the one that we don't know. We probably know the nominal interest rate when we are trying to borrow some money from the bank. When we are trying to become a homeowner, right? We buy a house, we take out a mortgage, and the bank tells you, hey, every year you have to pay 3%. But what the problem is, when we try to buy a house for, let's say, a 15 years mortgage to take out, we usually don't know about the inflation rate in the future, and no one can predict it. So that's why usually you will have to kind of like project what the future inflation rate is, and then to determine what you are actually paying back, which is the real interest rate that you have to pay for the mortgage. Well, same on both sides, the borrowers and the lender, they will care about this inflation rate so much in the long run, so that they can figure out whether they should take out a loan or maybe they should lend out some of their money in return for the future incomes or whatsoever. So that's why this Fisher effect actually explained to us that since we never know the inflation rate in the future, so the real interest rate that we always calculate in our heads are usually the one that we call the expected real interest rate. And the expected real interest rate is usually unaffected by the change of the expected future inflations. So one quick example here is when I'm supposed to expect to receive a real interest rate of 5% in 1 year, expecting and also expecting the inflation rate to be 5% in the same year. So what should be the nominal interest rate I would agree to basically make a saving, or maybe loan out, or maybe lend to someone. So if the expected inflation rate will go up by 1%, let's say, right, what should be the nominal interest rate I would agree? Well, if the expected inflation rate will go up by 1%, my expected real interest rates is still 5%. That means, well, now I have 1% of prices that will go up. When I'm getting back the money in returns, I will get 5% additional. So if you have this expected inflation rate go up by 1%, and the nominal interest rates should be the one minus the 1% that equals to the 5%. So that means, well, when your real interest rate, expected real interest rate return is 5%, the nominal interest rates that you should agree upon to this investment or to this loan or lending, you should actually get at least 6% in return from the borrowers. So this is the case where you have to have like at least 6% minus that 1% in order to return the expected 5% in real interest rate. So whatever the nominal interest rate presents, it's important to you, but you have to also pay attention to like what are you projecting to get back, and well, that will be the real interest rates, expected real interest rate, and what you are projecting for the inflation rate in the future, which is the expected inflation rates in the equations. The nominal interest rates are the ones that will give you an idea whether it's worth it or not. So again, this Fisher effect is going to be very useful for us later when we try to think about the changes of prices and change of inflation rates, or maybe the change of real interest rates. So please do the reading in this sections. Try to understand a little bit more from the reading. Again, we have covered all the topics in chapter 10 now, and I'm hoping that you can do a little bit of the readings from the textbooks. We will come back next time and trying to build our first macroeconomic models in the next chapters. So I will see you guys next video.